Hey everyone, and welcome to the Credit Shuffle Show. Today we are going to be reviewing the be-all and end-all of finance and investing books. It's The Intelligent Investor by Benjamin Graham. Now, Benjamin Graham was actually Warren Buffett's teacher. He was a lecturer at Columbia University. Warren Buffett read his book and then went and studied under him. And Warren Buffett, one of the greatest investors of all time, basically says that this book is the best book on investing that you will ever read. Now, this is about a type of investing called value investing, which is what Warren Buffett does. It's what his teacher Benjamin Graham did. It's certainly not speculation or day trading or anything like that. Actually, at the beginning of the book, Graham outlines what he terms as investing as opposed to speculation. And basically, investing is where you aim to preserve the capital and you thoroughly research the stocks so that you can kind of, within a certain extent, guarantee what kind of earnings you're going to get from that investment and many years down the line. Now, the beginning of this book basically tells you not to invest in mutual funds. I think it's in the first chapter. He talks about what a terrible deal mutual funds are. So that's definitely something great for anyone, and that still stands true today. This book was written in about, I think it was 1949, and it was updated throughout the years. I think the last time it was updated was in the 70s before Benjamin Graham passed away. But a lot of the stuff in it still stands true today. So, he talks about all the usual things that you'd expect: how to research a stock, PE ratios, earnings, all this kind of stuff. And then talks about what type of investor you should be. So obviously the book's called The Intelligent Investor, so he's teaching you to be an intelligent investor. But he talks about different types of intelligent investor. You have the defensive investor, who is someone who is a lot more careful. You can also be called the passive investor because they invest in a sort of set it and forget it type of way, where they will just buy stocks or funds and then just able to leave it and allow it to grow. And then you have the entrepreneurial investor, who is someone who is willing to, and has the time as well, to do a lot more research, to look for undervalued companies that they can put their money in and watch that grow over time. He also says that most people really should be the defensive investor because the entrepreneurial investor approach does require a lot of time, too much time for someone who also has a full-time job at the same time as being an investor. He also talks about asset allocation. So one of the interesting things that I felt was he talks about having 75% of your portfolio in stocks as the market is rising, and 25% of it in bonds. And then as the market, kind of hits the peak, or what you think may be the peak, you start to sell off your shares, and you aim to approach having 75% of your account in bonds or other fixed income assets by the time the recession hits, and 25% in shares. And you can then sell those bonds off and transfer back into stocks, buying up stocks at cheap prices when the market hits rock bottom. And it's this asset allocation, a 75-25 rule. And obviously it doesn't have to be 75-25, but he says that you shouldn't go past 75% in either asset class, stocks or bonds. Now, obviously, things have changed quite a lot since then. The bond market has also changed. Now is not really the best time to buy bonds. And I myself don't really know too much about the bond market, but I kind of adhere to the spirit of what he talks about. So I have, quite a large proportion of my account in stocks. But then I also have some other investments, like I do have some gold. I have some cash on standby so that when the market does drop and shares are basically on sale, I have some cash to buy up cheap stocks with. So I kind of accord with the spirit of what he's saying, although I myself am not, in the bond market, and I haven't thoroughly researched bonds. So, I don't really want to invest in something that I'm not super familiar with. But it is very, very good advice. So let's talk about, some of the pros and cons of this book. So obviously the pros are basically everything you need to know as someone who wants to invest is in this book. So we talked about the book Unshakable by Tony Robbins a few weeks ago. Like, everything in that book is in this book, okay? It's just that book's a bit easier to read. And so, yeah, basically the cons are it's a long book. It's about 600 pages or just under 600 pages. It was written a long time ago, so sometimes the style of writing, it's a little bit dry, it's a little bit old-fashioned. And that can kind of make it a little bit heavy going. It's not super concise, so, you know, if they wanted to make it more concise, they could probably cut it down by a third, get it down to maybe 400 pages, but just as much info in it. So that is something to think about. If you buy the book, you definitely want to get one of the most recent version, because obviously it was updated several times during the up to the 70s when Graham passed away. But then more recently, there's been commentary added to each chapter that updates it even further. Talks about, you know, modern scenarios like the dot-com bubble and, you know, modern companies. You know, some of the companies examples that Graham had in the book don't even exist anymore. They've gone bankrupt or they've merged or whatever. You know, you can't find them anymore. So, you know, that's one of the cons. It's kind of this hard going, it's a little bit old fashioned, but the pros are basically this is everything you need to know, and probably about the most reliable form of investing that there is. You know, fund managers mostly fail to beat the market over the long term. And he explains in this book, you know, Graham explains in this book some very interesting things, like you'll have a fund manager who's got great returns one year, okay, so he's made like 20% one year when the market did like, you know, 7% or something, right? And everyone flocks to his fund like, wow, he must be a great manager, wow, wow, wow. But, you know, it's the same as with the stock market. You know, after the stock market has had gains, you don't want to invest then, you want to invest when it's low and wait for the gains. Well, it's the same kind of when fund managers, you know, if you see someone who's had great returns, chances are the following year they're actually going to have very poor returns or even make a loss because they did so well the previous year. A lot of it is luck, you know, and a lot of people, basically 90% of fund managers or a huge number of fund managers fail to beat the market. And so that's where Graham's value investing strategy really comes into its own. Guys, have you read this book? What do you think of it? Leave your comments below. I'll put a link to the book in the description box on Amazon.com if you want to buy it. If you purchase from our link, we get a small commission, so you don't have to purchase from there, but you know, it would help out the show if you do. We'd really appreciate it. Anyway, leave your comments below if you've read the book. Please subscribe to our channel if you're new. Give this video a like, and we'll see you next time. Bye.